Hello folks, my name is Eric Wilkinson with Pro Trader Strategies and welcome to my daily market commentary. It's Thursday, April the 8th, and we have some economic data to go over, a lot of things to actually talk about, and then we'll get on with some market analysis and possibly talk about some trades that I'm looking at. So, across the pond, we really didn't get a whole lot. Japan consumer confidence, though, came in at 36.1, expected to be 35.6, so slightly higher than expected there. The economic watchers sentiment, kind of similar to a PMI number, coming in at 49, expected to be 45, so below 50, but still a nice number above what was expected there. So we're not really seeing, massive rebound in the economy there, but we are starting to see some nice inroads happening there. Now we'll talk about here in the United States, we got our natural gas storages coming in line with expectations at 20 billion cubic feet. The other thing we saw was unemployment claims coming in at 744,000. This is people that are not working, claiming unemployment because they are unable to find a job. 744,000, expected to be 682,000. Last month's number was revised as well, up by 10,000, so higher claims. Now, with this number, we just saw the JOLTS job openings. There's a lot of job openings, but right now we're seeing unemployment claims, meaning those people can't find a job. There's a bit of a disconnect there. Is it because there isn't enough incentive for people to work right now, to go and get those jobs? Now you think about it, when we're talking about strength in the labor market, when people are hiring, if there's a lot of openings and a lot of people vying for those openings, that means that wage pressure starts going down, right? Me, as a person looking for a job, I have to accept maybe a lower paying job. So there becomes this balancing act of whether or not it is more beneficial just to stay on unemployment, especially with the little boost that we're getting, or is it better to go out there and find a job? Well, that seems to be something that the economy is trying to work through right now. Remember, jobs are just the same as supply and demand, right? Well, if the price goes down too low, well, then people will look for a higher price or higher wages, right, by going out and looking for a job. So we're starting to kind of see those levers and pulleys work through the markets right now. A couple of other things that we saw going on in the markets right now really is this battle of the bulls and the bears. And now you guys have heard me talking about this for some time now recently, where I'm talking about we've seen this massive rally in the overall markets over the past year. That has been pretty much a parabolic move for the most part. Anytime we see the markets make these massive moves to the upside in the past, and we see volatility at extreme low levels, so the market's at extreme highs, all-time highs, VIX at extreme lows, that's starting to set up for a bit of pain, I believe, and the pain would be to the downside for the risk, I should say should be to the downside here more so than the upside, because we've already seen this nice, real massive move to the upside. We are heading into earnings as well, so I think we're going to start seeing some consolidation, at least for the next month or so, till we start seeing some more information come out about these earnings and how well these companies are doing with the latest round of stimulus. Now, most likely they're going to be doing very well because of this velocity of money, but we are going to probably have a higher expectations of earnings heading into this one because of that. Now, also, the bears have an argument where if we start seeing inflation get too hot, interest rates are going to have to start going up. They're going to have to start trying to slow down spending. That could exacerbate a move to the downside. So we have both of these things really playing out, a bull and a bear. Both of them are pretty solid arguments on directional moves here. And we're going to have to really keep our eyes on it. So I've talked about this. I think we're going to see some more volatility here in 2021, maybe even into 2022. But I don't think we're going to see like a massive 10%, 20% correction in the overall markets to the downside. I think we're going to see more of this volatility where we see smaller corrections and more of a range-bound type of trade throughout the rest of 2021, and then heading into 2022, we might make another move. All right. So the rest of 2021, though, I do believe we're going to see some volatility, but it's going to be within shorter ranges here as people filter through some of these positions, right? If you've made a lot of money, you see that underlying start to trade sideways. Usually that's a time to get out of those. So that's what's going to cause this volatility. Some people that feel like they missed out on it will pick it back up. So I think we're going to see that for the rest of the year. And with that being said, let's get on with the markets. I've talked quite a bit about theory going forward. We've got the gold futures coming. Gold futures are rallying. Crude oil was coming off slightly, but we've got gold moving here nicely up $13 on the day, but it is going to be bumping up against this trend line that we have here where we made this big, huge flag pattern. We are going to be bumping up against that. That should act as resistance. Note that it is lining up with the 50-day simple moving average as well, so that could doubly impact that move to the upside. We got the Bitcoin moving higher today, reversing all of yesterday's losses. Bonds unchanged for the most part, but moving higher. Interest rates moving slightly lower here, and it's not making a major dent, but at this point we're starting to watch this build out here. We've got the VIX 16 still teens, which we used to say in the teens was high volatility. Well, that's low volatility right now, and this is what I'm talking about. We've seen these massive moves, all-time highs. Now we're seeing VIX at 52-week lows. That to me is a recipe to start being a little bit nervous. All right. And we got the Dow Jones Industrial Average off a little bit today while the NASDAQ is up nicely. The reopening trade not working very well. As a matter of fact, a lot of the EV stocks as well are not doing too good. Yesterday, we saw a late day massive sell-off in a lot of these casino stocks. Now, that to me, especially with the states being a little bit more lenient or being more accepting of online gambling, that's going to limit some of Vegas's exposure, specifically that location. But these casinos have their fingers everywhere, folks. So it's not necessarily going to hurt them as bad. As a matter of fact, it might even help their bottom line margins because their costs on an online bet versus the margins on a in-house bet or at the location, the online has got to have more profit margin on it, in my eyes, because you're not paying for the brick and mortar, right? Anyway, we've got NASDAQ moving a little bit higher today as some of the stay-at-home trades are doing well. We're seeing France start to lock down while Disney is opening up here in the United States. All right, E-mini S&P is slightly in positive territory, making a new all-time high, but that was made overnight. We've been touting that we've been getting these all-time highs during the day session. We're not seeing that right now. It was overnight. Something to note, yesterday when we were watching this, the value area low in yesterday's session was a little bit extended to the downside. It ended up being a total inside day yesterday. I was kind of expecting to see this kind of drag out to the downside, maybe some weakness into the later parts of the day, get that point of control moving down. That would give us a signal that the equities were topping out a little bit here. Having said that, I haven't done a whole lot, folks. I haven't added anything to my portfolio at this time or taken anything off, just keeping an eye out for opportunities in the market. I think I found some, even high volatility opportunities in the market. Yes, there are always some opportunities in the markets to take advantage of high volatility. Right now, we're seeing pretty much low volatility across the board, and this is heading into earnings. So we're going to keep an eye on that. Like to see a little bit more volatility creep into the markets heading into this earnings season so we can take advantage of that. With that said, though, at this point in time, across the board, pretty low volatility, high all-time highs for most equities, and that to me is something that should raise a red flag here or at least put you on guard or in cautious mode. All right, folks. That's all I got. Today we're doing a webinar on the short put. When can we take advantage of that? How are we going to take advantage of that? And why we would take advantage of a short put for a bullish assumption. We aren't just picking option strategies out of the hat. I didn't come into the day basically thinking you need to add a certain strategy to a portfolio. No, what we do is we look at our assumption and then optimize the underlying internals, if you will, to find the best strategy. All right, that's all I got. Hope everybody has a great one, and I hope to see you today in the webinar where we are looking for swing trade setups and then taking advantage of that using the best option strategy. Take a moment to go over our disclaimer. As we're an educational company, I'm not here to solicit you guys or any of that jazz, but I am here for, if you can't take that, take it easy.